I think we're going through the pandemic response, and the economies have been hit globally. And I think that's what we need, is we need continuity. And in Japan, I think you will see that. I think you will see that the Bank of Japan will keep doing what it's been doing, and the government will continue to focus on the same economic policies they have in the past. So I think that's positive for the recovery longer term.
It's notable with very low yields that we're seeing a lot of volatility move into some of the foreign exchange trades. And there's some chatter over the weekend about whether the market will try and test the resolve of Suga to intervene in the currency. Are you hearing anything on that front, and do you think it's likely?
Well, I haven't heard anything specific on that front. I think that you will always, when you get new people in government, the market will always try to figure out exactly what their resolve is, exactly how much they will continue the policies of the previous administration. And so I think it's natural that they will, try to do that. But, we have rates that are pretty much at zero across the developed world. So there's not the interest rate differential that there has been in the past to really try to force that. And so I think from that perspective, it will probably be a relatively muted response.
David, good morning. One of the big topics of discussion that's come about with the Fed meeting, but also the European Central Bank, also the Bank of England, is how much more these central banks can do to stimulate growth, not just to provide and ensure liquidity, but to actually stimulate economic activity. On that front, do you think we're at the end of the road, or do these central banks have more in the toolkit that they can pull out to actually get the economy growing again?
Well, I think the central banks do have a tremendous amount more they can do by continuing to grow the balance sheet, looking at buying different assets that they haven't previously. Most of those three that you spoke about are focused on the government bond market, whereas the ECB has gone more into the corporate bond market. But you can see that expanding more and more if necessary. I think that all of them have also focused on that we need fiscal response. And in Europe, we've seen a good fiscal response now. The U.S. has seen some fiscal response, but there's probably more coming. And in the UK, there's been quite a sizable fiscal response. And so I think what we're seeing is that the central banks really do have to work in tandem with the fiscal authorities. And if you don't get that, the recovery will take even longer. But what we do know is that rates are going to be down here for the U.S. said 3 years. In Europe, it's probably 3 to 5 years. UK, probably similar. And so the short end of the curve is going to be very well anchored. But I think what's interesting is how they are more willing to allow inflation to creep up longer term, and I think that could actually make the longer end of the curve in, 12 to 18 months think about should yields be slightly higher. Not immediately. We have to get through this recovery first.